Welcome to the Curiosity Crisis. This podcast isn't about topics, it's about an approach. We take eclectic, timeless ideas and distill them into clear commute-length episodes. Designed to help you practice the art of curiosity, this show is for curious minds navigating a busy world.
Luke, how you going?
Good, thank you. How are you?
Very good. What are we talking about today?
Today, we're going to cover bubbles. Now, everyone might have a feeling that we're already in one, and we might tackle a little bit of that at the end. But generally, we want to talk kind of theoretically how they are and what they are, and then give some examples that maybe some niche ones that people don't know about, and just kind of look back at history and see how some similar effects constantly happen in our capitalist economy.
Yeah, I'm very excited for this because in the research for this episode, as it turns out, bubbles are a massive, massive part of our history and our economic history through capitalism. So keen to dive in. Before we go, though, what is keeping you curious at the moment?
Yeah, so I have actually something very related, and that is the housing bubble. So
Okay.
I have been researching as to whether we are in a housing bubble or not, and kind of the obfuscated data on where housing is and who owns it, and the debts and the abstraction away from just buying and selling. And I've been learning about that in America, and I've been wondering how much it will kind of trickle down and have a similar effect in Australia, even though we've had different political policies, and just kind of how similar that might be. So yeah, what about you?
Well, that's very interesting. I've thought about that in the Australian context, and I have some thoughts about the policy settings and everything around here, and how there's a lot of things that go into a bubble. But we'll unpack that through this episode. What's keeping me curious? It's a little bit of a follow-on from some of the curiosities in the habits episode that we talked about way earlier this year. But I started the book, The Power of Now. And it's all about, presence and I guess the now, the moment that you're in right now, and presence in your physical space, and what you're doing is all you really ever have. So it's really interesting, but it draws a lot of ideas and parallels to meditation, which I've really gotten into and made a habit of this year.
Nice.
So it's been really interesting. And one of the key learnings that I've taken so far is obviously about that presence, but also about, I guess, if you're in a situation, you have three choices. You can either accept it, change it, or leave it, remove it. So that's just an idea that's been sitting with me, and I think it's a really simple way to boil down some of the biggest things you have in life, really. So
Nice.
Yeah, it's cool, but I will warn it, it's a tough book to read. It is dense. Yeah, so
it's dense.
You need another book as well, just to make sure you've got some fun reading.
Okay. You can't meditate on the book. It's awesome. That's so good to hear. Well, we're just going to kind of kick things off with a theoretical framework. So, there's a lot of ways to approach kind of this episode. And Kush and I have had to take a view through some lens, okay? And we've kind of chosen this one, which is that bubbles are an immutable cycle. And essentially what we're saying is that it's part of the system. It's something that happens. And we're backed up by something called the Minsky model, which is essentially that it's this financial instability hypothesis, and it argues that stability is destabilising and prosperity leads to excess debt and then therefore fragility. And so what we're saying with this immutable cycle kind of stand is we're saying that this is just part of capitalism. It's not necessarily a good thing. We're not arguing about how good it is, but we're just saying that it is part of the system. It's driven by a shift from rational exuberance to irrational mania, and we're going to look at some of those examples.
Yeah. Do you want to get into the 5 stages of basically what a bubble has?
Yeah, so if we're looking further at the theory of it, there's kind of like, broadly speaking, there are 5 stages that are accepted. And so the first one is displacement, which is like a new technology or a paradigm that disrupts what has been previously existent, right? And then you have the boom phase. So it's rational pricing based on this technology, right? So it's based on fundamentals. So we've gone displacement and then boom. Then we get into the euphoria phase, which is it's caution is abandoned. It's full leverage is introduced and things go crazy, which is that irrational mania that we were talking about before. And then you get into profit taking. So smart money essentially leaves the identification of, hey, this is a little bit far. Then you get that pullout, and then finally you have panic, which which ends up dropping the price. It's full collapse and credit contraction. And essentially these 5 stages, you can categorize them slightly differently. You might change the names, but broadly speaking, this is the kind of roadmap of how this plays out.
Yeah, I'm sure most of our listeners will have seen at some point a graph about bubbles and that sort of cycle where you go into, the whatever you call it, cavern of despair, and then there's that hope and exuberance, and then it all comes crashing down. So there's tons of different depictions of it. But to add one more layer to that, I guess, with those 5 stages, I guess that's happened all throughout history. If we talk about the money and where this inflation of price is coming from, so looking at financing at the start, so in those displacement and boom phases, I guess we know that there's already an economy functioning around changes in new technology, and the most basic, I guess, financing that exists in normal conditions, let's say, is hedge financing. So in those first 2 stages, things are financed backed by something pretty traditionally, and the amount of credit is typically, I guess, less than the amount of value being generated. And then in that next phase, when you get into sort of the euphoria, you mentioned leverage is introduced. So that's where much more of the speculative financing comes into it. And sometimes that's good. Like sometimes leverage actually is a great wealth creator. And I think we've talked about that in some other episodes. But it is, at the end of the day, it is speculative. There is more risk involved, and it's caution. I mean, I guess in the euphoria phase, it's abandoned, but it's typically when it's advised. But then right at the end, like towards the end of that, that's where you mentioned there's profit taking, so smart money exits. But there's that's sort of when the real like froth is in the water. It's unclear, but there's a lot of hype and exuberance around. And that's where it gets really, really completely dangerous, and the risk is not proportional to the reward. And that's where there's a term called Ponzi financing. So all sorts of dodgy offers coming out, not necessarily backed by anything. Every mom and dad is getting out there. It's the hot thing to be in, and that's right before the panic and price collapse, and then a lot of people just losing their shit. So just to back your stages up, that's sort of how I guess the money typically can work in a bubble.
Yeah, and as part of this research, we're looking at fantastic graphs that an audio listener will not have the ability to see, but
no, but we can put it in the show notes.
Yes, we can put something in the show notes.
Today's episode is sponsored by OptiVenture, the ultimate all-in-one supplement system crafted exclusively for hikers and outdoor adventurers. OptiVenture's unique day and night formulas provide everything you need, from essential vitamins and minerals to probiotics and omega-3s, timed perfectly to match your body's rhythm. The day formula boosts energy, immunity, and mental clarity, keeping you strong and focused on the trail, and the night formula supports deep recovery, reduces inflammation, and promotes restful sleep so you wake up ready for the next adventure. Join the tribe and elevate your outdoor experience. Check out optiventure.co to learn more.
Yeah, so do we want to get into some pre-industrial bubbles, some quick examples of some other things that have happened?
Yeah, and as you mentioned, bubbles are just a naturally occurring part of capitalism. Of course, capitalism is all about wealth creation, value creation, and if there is something that's being created, then the tendency is to try and exploit it or grow it as big as possible. So we'll go way back in time, start pre-industrial, and the first example we've got is the South Sea bubble. So basically that was characterized by a debt for equity swap, so a scheme to convert government war debt into South Sea company shares. So the company needed constant stock inflation to make the swap work. Then there was the Bubble Act, which was ironically lobbied for by the South Sea Company to ban other startups, so nuisance bubbles, and funnel all the capital into their own fraud, which is very it's hypocrisy. But then maths versus mania, the MP Archibald Hutchison mathematically proved that the valuation was impossible months before the crash, but it was ignored, and then as we mentioned in the cycle, it all came crashing down and it fell over because it was not backed by fundamentals. So that that's the earliest example we've got, but you've seen that in other instances.
A great parallel to that about the math versus mania was the Japan housing crisis, where, it was I think the Imperial Palace or something in Tokyo was worth more than the entire state of an American state, in terms of like that landmass proportion is not equivalent at all, right? Like a small little square in Tokyo being the equivalent of an entire state is ridiculous. And, that's obviously irrational. But the mania continued and eventually everything collapsed. But it's funny that it can be obvious and yet it doesn't matter.
Exactly. And one thing I'll just point out here is the creation, and we talked about this again just briefly in the stages of the financing and the stages of it. You'll note that there was another instrument set up. So it wasn't like a swap for value, but the debt, that financing, that Ponzi financing, ended up growing out of proportion, and they actually banned like money from going into similar things, like other similar ventures. And then when it was proved that it was mathematically impossible, it all crashed. So it's that introduction of these new the new instruments that become a little unclear. So yeah, it's cool. Yeah, watch out for.
The next kind of example that a lot of people will know is the Railway Mania of the 1840s in the UK. And there was something called the scrip mechanic, where basically investors only had to pay 10% deposit to buy shares. And so it created this huge leverage, right? Because you only needed 10% of what you were buying. And so the 100% rise in share price yielded 1,000% profit on the deposit, right? And which is ridiculous. But that also means that you're heightening the ability for this thing to crash. And so then there was a media war. So the Times warned of labor shortages, while the industry funded papers to hype up this boom, and being like, railway, this is everything. And then, it was actually a productive bubble too, right? So if we compare that to something like tulip mania, which was an example of the price of tulips going through the roof, that wasn't actually benefiting anyone, right? Because it's the price of a flower, which is not a productive kind of asset or commodity. Whereas these railways could then be used to transport things in the future, but that doesn't mean that they weren't overvalued. And so it powered the industrial economy, but at what cost, right? Yeah. So that was another really interesting example of a bubble.
So just on that one, like we mentioned at the start, like, bubbles are inherent in capitalism, and, sometimes they, like we said, they're not necessarily bad, because some people will lose a lot of money, but, this one left behind like really, really useful infrastructure. And then there's other examples which we'll get to, like the .com bubble. Like the internet is still the backbone of everything we do, in today's economy. So it's not all bad, but it is obviously just a byproduct of capitalism trying to create the most value out of whatever's happening at the time. Now, this next one, I'll go through it quickly, but it is very topical to Australia and mining, and we've recently done an episode about critical minerals, so a little bit topical. Basically, Poseidon nickel. So there's a supply shock back in the day for nickel because of the Vietnam War demand and Canadian strikes, where they were mining nickel, but production dropped. And then there was just a ridiculous vertical ascent in Poseidon's shares. Poseidon's a mining company. They went from 80 cents to $280 based on a discovery at Mount Windara, one of their tenements. And then this is actually still a thing today. There was sort of address mining, so a nearology bubble where any company with a lease or a tenement near Poseidon just skyrocketed, which is so funny.
That's crazy.
But that still happens today. But then the legacy is the rampant insider trading led to the formation of ASIC, so Australia's financial regulator, which... Again, not a great thing for the people that lost money and the insider trading that happened, but something constructive did come out of it. So, there you go.
It's funny that neurology still happens. Someone discovers some gold and they're a gold miner, and suddenly everyone who owns mines nearby, their share price goes up based on literally no other information than, I guess, there could be more gold maybe nearby. But,
It's next door, surely.
Yeah, exactly. Very optimistic.
Actually, I might take this one, which is retail collectibles, because the next one is something that you're really close to, which I'm actually really keen to get into. But bubbles come in lots of different forms. So we've talked about financial ones and backed by assets or infrastructure, or sort of started by those things. But there's also retail collectibles, so Beanie Babies in the late 90s. Essentially, it was fabricated, so there was a retirement strategy by creator Ty Warner, artificially limited the supply by retiring specific toys to incite panic buying. So this is definitely an example of a non-constructive bubble.
Yep.
Then there was the eBay factor. So in like the early internet, it was part of the first internet amplified bubble. So high eBay sales validated this investment thesis that there was they were going to be really rare and grow in value. But in the end, a stunt announcing the end of production in 1999 broke the spell, and prices collapsed more than 90%. So a lot of people lost their money or lost their the paper value that they thought they had with these Beanie Babies. So again, can happen in all sorts of forms, and this one was fabricated, but anywhere that it can be exploited.
Definitely. And I think we've got a great example now, which is about virtual economies or micro bubbles. And again, these are not productive. So some listeners might be familiar with Team Fortress 2 or CSGO, which are two video games. And they have skins, so you can change the color of your gun or your knife or your character. And those items, in-game items, have significant value. Like we're talking thousands of dollars. And we'll get into the CSGO skins, but that had a market cap of billions, which is actually insane to think about. So one of the big risks here was the God risk, which is that both of these games are produced by a company called Valve. And so these virtual economies are uniquely positioned to be affected by the developer. And Valve can alter the supply or freeze assets and completely influence the market here, the secondhand market, that is. And so that's really important, right? Because if they say, oh, suddenly there's an influx, you have zero control of the supply, and that's all a company. And they're not making money off the buys and sells of these items either, right? And so I think these were kind of the original NFTs almost, right? Like an in-game video game skin. And I think there's a big question there to be talking about, where did the value capture? Is it the thing that sits on top and it's the collectible, or is it something more underlying? And so then they had the Great Depression for Team Fortress 2. So in 2019, a bug caused rare items to drop 100% of the time, causing instant hyperinflation and a market freeze. So essentially, there was this bug that meant that everyone was getting all of these crazy rare items. And so your scarcity now, which was causing this bubble, disappears overnight. And I'll give a really interesting example, which actually happens really recently. With the CSGO skins, so this is Counter-Strike, and before 2016, skins acted as an unregulated casino chips for gambling, because basically they had this box system, and basically there was a little bit of a probe into the company Valve that makes this, and goes, hey, this is unregulated gambling, like you can't have this. And so the developer is forced to do something about it. And so in this scenario, because of a legal crackdown, they changed the economics of it. And so $5 billion of this market was wiped out. Like actually billions of dollars of these skins was wiped out because they affected the supply and demand equation. And it was the same thing about scarcity. That was diminished by, the way that they had to change this. And they changed this for legal reasons, not because of anything that the players did. And so again, very unproductive bubble, but really interesting to see kind of this simulation of economics in play with real human kind of, psychology.
Yeah, that's really interesting. Like the factors of economics there are real, but the product or the thing that they're valuing can disappear into thin air or like into, at the end of the day, sorry, it's virtual. So as I talked about in that first example, like, one of the features of bubbles can be the creation of artificial instruments or products. I guess the way the economy worked around it, the supply and demand was standard, and they were trading actual money for it. But the product almost ceased to exist, which is just insane.
What's fascinating about this one was that it was almost like people began to trade these skins. Like you could have no affiliation with the video game, and it was just a layer of abstraction of some commodity or asset that was being bought and sold on a marketplace through the video game being the enabler of this. And so you could be like a CSGO skin trader, have no interest in the video game, and just purely see it as a financial commodity or asset to trade, buy and sell. And it's really interesting that how people dealt with this, and it's actually a fascinating case study.
Yeah, it's so interesting. And like those financial products and like representations. I mean, that's a common. I guess that's common across a hell of a lot of markets, especially commodities, and we work in energy. That happens all the time, but because it's based on a video game, it's just so unique.
Yeah.
Just jumping in for a quick break. We'd love it if you did us a favor and gave us a 5-star review on your podcast player. We'd really appreciate it. It helps grow the podcast and get to more ears. Thank you.
I'm going to jump into some more modern macro bubbles that I think our listeners will be more familiar with than some of the more historical ones. I'll start, and then I'm going to pass over to you for the second one, because I know again that's something that you're closer to. But the .com and housing bubbles, so obviously much more recent and front of mind. But I guess one thing that's interesting about this is in modern bubbles, the warning lag around modern bubbles, because what we've seen is they persist long after experts identify them. So then there's credible doubt as to whether they actually are a bubble. For example, the .com bubble, Alan Greenspan warned of irrational exuberance, which you talked about at the start, in 1996, and the market didn't actually peak until 2000, so over a 3-year lag. And then the famous housing crash, which caused what we call in Australia GFC,
Great Financial Crisis,
Great Financial Crisis, sorry. But Robert Schiller identified the decoupling of prices from rents in 2005, and then the crash didn't actually hit until 2008, where that's historical. But that's something to I guess be wary of, and makes it really, really hard to decipher this, because in history they took months, not years. So it was a quicker cycle.
Definitely. And yes, so another modern bubble would be crypto or NFTs, especially 2021. And so this was characterized as wash trading. So essentially fake volume being traded between these different assets, and because of a lack of utility, really. And so 95% of NFTs eventually hit a market cap of 0. And you could play this into a bunch of things, whether it became an oversupply or a realization of affiliation with utility doesn't equal utility. So, a blockchain data structure, it has value given, trustless validation, like a PayPal or something would, right? But that doesn't mean that an image sitting on top of it has any inherent value. And so you could categorize it as a bunch of things, but it still has the same fundamental characteristics of the other bubbles that we've talked about, where there's overexcitement and irrational exuberance, and you get into this mania phase. And the other thing that's really interesting about all these bubbles is just because something doesn't have value or shouldn't have as much value as it doesn't mean that you can't make money on it. And so that's where, it's kind of like feeding the fire of the bubble, where if someone sees, I can make money off this, they don't really care if it does not have an equal value to what it should, right? Because they can see that, well, I think the can's going to get kicked down the road and the crash is later, so I'm going to make money off this.
Yeah, make money now, and then we'll deal with the fallout later. Which is really, that's hard. It's hard to sort of, think around and advise on that. Obviously, nothing that we say is financial advice, but so let's go to our key conclusions and sort of what we've learnt by doing this. Where do you want to start?
Yeah, I mean, I'd love to start with this first one. I think this first one's fantastic, which is about bubble duration, and you touched on it before with the warning lag, and that is that modern bubbles seem to last longer. So 2 to 3 years after warnings, compared to the 20th century bubbles, which could be months, which, you talked about that before. And there's a number of reasons for this, again, but I think a couple of the big ones is central bank liquidity and financial engineering. And essentially, like, a good way of viewing this is like a plumbing problem, where money is like a liquid that's flowing through the pipes, and it takes time for it to get out the other side. So if you turn on the money printer, and that's going to increase inflation, it doesn't happen overnight. It takes time for that to eventually trickle down into products and services and everything else. And we've seen that even recently in our lifetime, right? Even just after COVID, or there's lots of examples of that. But I think, the duration is actually a really interesting takeaway.
100%. And actually, because of these different financial instruments, and I guess the value that their bubbles of growth creates, there is like a tendency to want to protect that and keep it growing and keep that abundance occurring. And I guess it's in some people's best interest to keep it going right up until the moment it drops, like nobody really sees it coming or wants it to. So that one's interesting. The thing that I've taken away is there's a few different types of bubbles, and they're an inherent part of capitalism. But we've talked about a few. So there's productive bubbles, so they leave behind something that's useful. Railways, the internet. Zero-sum ones where nobody at the end. At the end you just left shirtless. Where there's wealth transfer only, for example, with tulips or NFTs. At the end there's not heaps of value necessarily. And then the systemic ones. So they actually can threaten national stability, where we're talking about like the South Sea, shipping and housing. So, if a whole, economy can't afford housing or housing values crash, that's quite dangerous.
The systemic ones are the really scary ones, really.
Yeah.
Because, no one's retirement fund is affected by NFTs absolutely bubbling over, right? But the housing, for example, is a really scary one. But I mean, if we look at our last kind of takeaway, we've got psychology. Yeah. And, what's inherent in all of this is that there's human interaction and therefore human psychology, and there's greed, and there's a lot of things that play into this that result in the way that things play out. And so the signs are always visible. So there's, media saturation and unsophisticated entrance, but solvency often expires before rationality returns. And that's really important, which is basically to say that the fundamentals can expire before the actual crash happens.
Yes.
And that's that irrational kind of scenario right at the end of these bubbles. And that's why things happen so suddenly.
So I guess the lessons I'm taking away from it is, I guess that there is money to be made, but like, I don't know, we've talked about it in lots of investing episodes, but for me, it's if you can't explain why you're doing it and where you see the value in what you're investing in or putting your money into, then it's a bit dangerous to not know, I guess. And then also like, if you don't understand, it doesn't help. And then if there is just money being made, I guess, play with it with what you can afford to lose, because you might make some and that'd be great, and other people are making some, but if you lose, it shouldn't wipe you off your feet.
Definitely.
Awesome. Thanks for listening. Find us at curiositycrisis.com and curiositycrisis on Instagram. We're on all major streaming services, so you can listen how you like. We have to ask a favor. If you got anything out of this episode and are getting value from the podcast, please leave us a 5-star review on your podcast player. That helps us be found by more listeners, and it helps grow the podcast. So thank you, and catch you on the next episode.